the March Madness that we have been seeing so far, is that going to be directly impacted by the changes that Fannie and Freddie are looking at putting into place come April 1, April Fool's Day for all of you. And so we're going to go over this. Excuse me, we're going to go through all the different trends that we've been seeing and where we expect to go and answer some of the questions that we've been volleying over the last, gosh, I'd say 4 days. I don't know why, but my phone's been just blowing up. And so before we get to that, hey, subscribe. Let us know what you think of the channel. If there's information you want to know, hey, just ask. We can talk about it. We'll post an answer to you. We give responses within about 30 minutes. And, well, we enjoy leading with generosity. So ask. All right. With that, make sure that if you're looking for a market update that is in real time, let us know. We can forward it off to you. It is super, super simple. We keep it so that everybody can understand it. We're not all, economic majors, and including myself. So I write them so that even I can understand them, which means that everybody can. And if I can hand it to my mom and my mom understands it, we're good. And so there we go. Nothing against my mom, but she's not in real estate, and she's not an economic major, but she is smart. All right. So she had me, right? Anyway, let's see. Ring the bell or click the bell so that you get a quick, notification when we do this. These updates are every Saturday. It's funny. I was just reading yesterday, about some of the market statistics that were happening in January. And I thought to myself, January. It is towards the end of March. So if you want real-time information that is valid, you need to come in and watch it. As an example, so last week, we gave all of you folks a heads up that looking at second homes and non-owner occupied financing, that come April 1, guidelines were going to change. And if you were on the fence, because banks anticipate, well, they get notified and they start making rate changes, cost changes, everything else. That happens before, yes, April 1. So we had, I don't know, I probably had 15, 20 text messages saying thank you. Thank you for letting us know about the change. Some of these folks are not even clients of ours. They just watch the video. They say, hey, we love your video. Thanks for keeping us abreast. We share it with our friends, and I think that's awesome. So I don't know, maybe I'll get to 100,000 followers or listeners. That'd be exciting. Anyway, let's get on with March. So March for sale, month over month, we're up 10.5%, which is really good. All right, here's what's really funny. New on market is up 34.9. Okay. Now, when we compare that to the pended, which is up 36.5, if we come back and we talk about the sponge, okay, and a dry sponge soaks in a lot of water. And again, if you think about it, and people tell me they love this analogy, which is good because it's a simple way to get people to visually understand this. If you have your counter, preferably kitchen counter, close to the sink, right? And you take a super dry sponge, okay, and you put it there and you start pouring water into it, and it just takes it in, it takes it in, but there's no water that is on the outside, okay? That's where we're at right now. We are just soaking it up. We cannot pour it fast enough because, as you can see, for new on market, we are still absorbing it. We are still taking more inventory off. When we come over here, we look at 1,472 came on market in the last 7 days. We're at 1,920 that came off. So we're still pulling down that inventory. That sponge is still soaking up that water. And until we start getting that balance where as we're pouring water in and all of a sudden, it just slows down. It doesn't absorb it as fast. Hence our absorption rate, which is another metric. You will find that in, yes, your area report. I do have fun. It's funny. We got up this morning, and I get up a little early because I like to hit the gym and whatnot. And when I was coming back, that you get that tune worm, and I had a tune worm stuck in my head. And it's funny, as I said to my wife, Jamie, I said, I think I'm going to start off this session today singing. And her immediate response was, and at that point I conclude maybe that wasn't a good idea, because she's a pretty good sounding board, and that one didn't come back. That didn't come back so well. Anyway, so when we talk about that sponge, we are absolutely soaking it up, all right? Because the solds are still up 18.3% month over month. Now, when we take a look at it year over year, okay, so our inventory is still showing down. This number, as we get closer to May and June, this number is going to change, and it becomes what I will consider more real for year over year, all right? And the reason is that as, you know, not March, but the end of April and then May and June, we saw a massive shift as we were told to stay home. You know what, that's what it is. We're kind of like big kids. We always do what we're told not to do. And they said, stay home. So we went out and bought more homes and made a crazy market out of it. That's it. I've concluded. I should be rich. All right. So this number is going to change. All right. It is going to come down more into the teens. We might even actually see a negative number, like, oh, hey, you know, or a positive number where we've had more homes than year over year as we start to, compare apples to apples, right? New on market is down 1.4%. Pended are still up 10.8%. Solds are up 11.6%. Not uncommon. We are still, showing those positive numbers as we head through the year. But again, all of these numbers, all of these metrics are going to change starting about May, June, and then into July. We're going to see all of a sudden, you're going to say, oh my gosh, these numbers aren't massive anymore. They're not massive because now we're comparing a crazy market to a crazy market, not a crazy market to a slow market, which is different, right? All right. Last 7 days, again, 1,199 homes went off market. 1,472 came on market, but still 1,920 that pended, okay? Now, one of the things about the headline said is are the changes that Fannie and Freddie are putting into place come April 1 going to have an impact? They will, but that's going to be for your second home. That is going to be for your investment homes, your rental properties. And yes, it will have a direct impact. Why? Well, right now, as you can see, owner-occupied still 3.375, still bobbling around there. I had a conversation with a client just yesterday, and they're like, well, George, it's not 2.6% that I've seen before. No, but that's so insanely crazy low that in my career I had never seen it consistently that low. It has to come back up. And I said, look, even if it goes to 3.5, that is an amazing rate. People just don't realize it. And so he's like, really, is that still a great rate? And I said, it is an amazing rate. So I meant to send him, some, a couple of years ago rates, which were mid 4s, 5s. And people just don't understand that's still an amazing rate. Well, actually, I shouldn't say that. A lot of people are still seeing it as amazing rates. And hence, that's why we're still coming off market. But understand, it's not going to stay like that forever. It's not. Sorry. Just like our rates down here. So non-owner occupied immediately took a jump. It's not even April 1 yet. The joke's on you early. 3.875 with the loan balance below 548. I was chatting with Dan Golden at Cornerstone Lending. And Dan's response back is that, yes, we're starting to see some of this ramp up because Fannie and Freddie now have been given the rule that says only 7% of a portfolio can be second home and investment properties. Why? They want to maintain the integrity of the mortgage-backed securities of a portfolio. And some people are like, well, what does that mean? Okay. Well, if we have Bank of America, we have Chase, we have Qualstar Credit Union, I have Cornerstone Lending, I've got ABC Mortgage Company, whoever it is, they're all making loans. And they all write to Fannie and Freddie guidelines, okay? And then Fannie and Freddie, they take these into this big bucket, okay? And they pack them in there, and they all fit, and they all have this same conforming guideline. And let's say we have 100 of them. And actually, it tends to be more than that, like thousands. They're like billions with an S, billions of dollars of mortgages that go into this bucket, okay? And they will take these then and sell them to your hedge funds, to your REITs, real estate investment trusts. They'll send them to insurance companies. They sell them to people that manage your retirement accounts, called a mortgage-backed security, because they look at it as a very safe investment for you to get that return, so they protect your money. Well, when we exceed or have investment properties that start to become more involved into a portfolio, it makes that portfolio or that bucket volatile, because these people want consistency for 10 to 15 years is a good number that they look at it, because people refinance, they sell, whatnot, and things come out of the bucket. Things can't go back in the bucket, but things can come out of the bucket. So then they have to reorganize, or they will repool a set of mortgages depending on where they're at, what they're doing. And it just, for risk purposes, they only allow now 7%, which is a very low number. And that's why these numbers are changing, because any mortgage balance over 548 is now 4% with 1 point. And that is the one thing you are going to see are a few more points being added on to these rates. Okay? It's a given. Just understand they have to create these performing assets, which are also based on risk. And they transfer that risk to you. Okay? So be aware of that as you are shopping online for mortgages. If you see a rate that's like, everybody else is charging me 3.375, but I can get 2.8. Okay, well, you're probably buying down the rate and they're not telling you yet, right? They're going to wait until they lure you in to talk to them, and then say, by the way, it's going to cost you $8,000 to buy that rate down. You're going to be like, whoa, 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 time out a second. What are you talking about, $8,000? I just want 2.8%. I was talking to a mortgage officer the other day. It was absolutely hilarious. I don't know. He was quoted a really good rate. I think it was 2.8% on an ARM. And the guy came back and says, hey, listen, 2.6%. I'll pay you 2.6%. And it was hilarious because he thought this was negotiable. Commercial is negotiable. Lending rates for home, personal residences and units under 4%, that's not negotiable. Those rates are set. All right. And it just depends on the profit point of the bank, right? There you go. All right. So as we look at this, yes, March Madness is not taking a left turn. They are absolutely going straight. We are seeing a huge influx of homes coming on market, in as much as we're seeing a massive influx of homes going off market. We are still drawing down inventory. This number has not, the new on market has not exceeded the number of homes that are coming off market each and every week. And that is hugely important for sellers. We saw 183 price reductions and 67 expireds or canceleds. You should never see that. If you're a condo, that's a little bit different. Condo market has been struggling, and because of rate. That's a given, okay? There are certain things that will change. As rates go up, though, the condo market will become a lot more advantageous to buyers as they start to get priced out. And so they will look at ways of, basically creating a payment cushion that they can afford and want to realize. So anyway, with that, let me know if you have any questions. Make sure if you would like a market update for your area, you have to let me know what area you're in. We will send that off to you. There's no cost, and we can just post them. In the meantime, you guys have an absolutely fabulous Saturday, and I will take care. I'll talk to you on the next video, and I guess maybe I will take care of you. I guess we take care of you every single week, so we'll take care of you too. All right. In the meantime, take care, guys.